Something unprecedented is happening in America right now. Something that should be front-page news, but it's being buried, ignored, downplayed. Americans are pulling billions of dollars out of banks, not in a panic, not in a dramatic rush, but quietly, steadily, week after week, month after month. This is a silent bank run. And if you understand history, you know that silent bank runs are often more dangerous than the loud ones, because by the time everyone realizes what's happening, it's too late. Stay with me, because what I'm about to show you isn't theory or speculation. This is documented data from the Federal Reserve, from banking reports, from financial institutions themselves. The numbers don't lie, and the numbers are telling us something terrifying is happening to trust in the American banking system. If you have money in a bank right now, and chances are you need to hear this. Let me give you some numbers that should be on every news channel but aren't. According to Federal Reserve data, in 2023 alone, over $1 trillion was withdrawn from U.S. banks. $1 trillion. That's the largest outflow of deposits in modern banking history. But here's what makes this different from previous banking crises. This isn't happening because of a single catastrophic event. There was no Lehman Brothers moment. No dramatic collapse that triggered panic. This is different. This is millions of individual Americans making millions of individual decisions, all doing the same thing at the same time. They're taking their money out. Some are moving it to credit unions. Some are buying physical assets, gold, silver, real estate. Some are investing in cryptocurrency. Some are literally keeping cash at home. But the pattern is unmistakable. Trust in traditional banking is evaporating, and the banks know it. Look at what happened in early 2023. Silicon Valley Bank collapsed. Signature Bank failed. First Republic Bank went under. These weren't small regional banks. These were substantial institutions with billions in deposits. And they failed not because of bad investments primarily, but because depositors lost confidence and withdrew their money faster than the banks could manage. That's a bank run. And we were told it was contained. We were told it was isolated. We were told the banking system was safe and sound, but the data tells a different story. Since those bank failures, deposit withdrawals have continued, not at panic speeds that would trigger alarms and interventions, but at a steady, consistent pace that's actually more concerning, because it suggests this isn't panic. This is rational decision-making by informed people who've lost faith in the system. Let me put this in perspective. In a healthy banking system, deposits grow. They might fluctuate slightly, but the trend is upward as people save money, as the economy grows, as wealth accumulates. But we're seeing the opposite. We're seeing deposits decline month after month after month. And this is happening while the economy is supposedly doing well, while unemployment is low, while the stock market hits record highs. Something doesn't add up. And when things don't add up in finance, that's when you need to pay very close attention. So why are people pulling their money out? Let me tell you what they're saying, because I've been reading the forums, the Reddit threads, the financial discussion groups. I've been listening to what real people are saying about why they're losing faith in banks. First, there's the FDIC insurance issue. Most Americans believe their deposits are safe because of FDIC insurance, which covers up to $250,000 per account. But here's what most people don't understand. The FDIC doesn't actually have enough money to cover all insured deposits if multiple large banks failed simultaneously. As of the most recent data, the FDIC Insurance Fund has about $128 billion in it. Sounds like a lot, right? Except insured deposits in American banks total over $10 trillion. That's a coverage ratio of roughly 1.28%. In other words, the FDIC has about $1 for every $80 it's supposed to insure. Now, in normal times, this is fine. Banks don't all fail at once. The FDIC can handle individual bank failures, assess fees on other banks to replenish the fund, and everything works. But we're not in normal times, and people are starting to do the math and realize that if things go really wrong, FDIC insurance might not mean what they think it means. Second, there's inflation. Even though official inflation numbers have come down from their peaks, people can see with their own eyes that their purchasing power is eroding. Money sitting in a bank earning 0.5% interest, while real-world inflation runs at 3%, 4%, or 5%, depending on what you're buying, means you're losing money every day it sits there. So people are thinking, why keep $50,000 in a savings account earning pennies while inflation eats away 3 to 5% of its value every year? That's a guaranteed loss. Better to put it in assets that might hold value or appreciate. Third, and this is huge, negative interest rates policy discussions. In 2023 and 2024, there was serious talk among central bankers and economists about potentially moving to negative interest rates if the economy weakened. What does that mean? It means the bank charges you to keep your money there. You deposit $10,000, and a year later you have $9,800 because they charged you fees or negative interest. This hasn't been fully implemented in the US yet, but it's been done in Europe and Japan. And the fact that it's even being discussed is sending a clear message to savers. Your money is not safe in banks, not just from risk of loss, but from deliberate devaluation through policy. Fourth, there's the surveillance issue. Banks are now required to report transactions over certain amounts to the government. They monitor your spending patterns. There were proposals thankfully paused to have the IRS monitor all transactions over $600. People are realizing that every dollar they keep in a bank is tracked, monitored, and potentially controlled. And in a world where we've seen bank accounts frozen for political reasons, where we've seen governments seize assets, where we've seen bail-ins where bank deposits are used to rescue failing banks looking at you, Cyprus 2013 people are rightly concerned about whether their money in a bank is truly theirs, or just a ledger entry the bank can manipulate. All of these factors are combining to create a perfect storm of distrust, and when people don't trust banks, they withdraw their money. It's that simple. But there's another reason this silent bank run is happening, and it's something that most people don't know about yet. It's called the commercial real estate crisis, and it's about to devastate regional and mid-sized banks across America. Here's what's happening. During the pandemic, remote work became normalized. Companies realized they didn't need massive office buildings. Workers realized they didn't want to commute. So office buildings started emptying out, and they haven't filled back up. Current data shows that office occupancy rates in major U.S. cities are still around 50% of pre-pandemic levels. That means half of office space is sitting empty. And those empty offices represent billions and billions of dollars in commercial real estate loans held by banks. Now, commercial real estate loans aren't like home mortgages. They're shorter term, typically 5 to 10 years, and they often require refinancing or balloon payments. Between 2023 and 2025, over $1.5 trillion in commercial real estate loans are coming due. That's trillion with a T. And here's the problem. Properties that were valued at $100 million when the loans were made are now worth maybe $60 million or $70 million because nobody wants empty office buildings. So when those loans come due and need to be refinanced, the numbers don't work. The property doesn't have enough value to support the loan. What happens then? Defaults, foreclosures, and massive losses for the banks holding those loans. Small and regional banks are particularly exposed to this. While big banks like J.P. Morgan and Bank of America have diversified portfolios, smaller banks often have concentrated exposure to commercial real estate. Some banks have 30%, 40%, even 50% of their loan portfolios in commercial real estate. If those loans start defaulting, and they are starting to default, those banks are in serious trouble. And sophisticated depositors know this. They're looking at which banks have high commercial real estate exposure, and they're moving their money out before problems hit. This is exactly what happened with Silicon Valley Bank. People who understood the bank's exposure to interest rate risk withdrew their money preemptively. By the time the general public heard about problems, it was too late. The bank had already failed. So right now, there's an information asymmetry. Some people understand the commercial real estate crisis and are acting on it. Most people don't know yet, but they will. And when they do, the silent bank run could become a loud one. But it's not just regular Americans pulling money out of banks. The wealthy are doing it too. And when the wealthy move their money, that's when you really need to pay attention, because they have access to information and advisors that most people don't. Data from wealth management firms shows that high net worth individuals have been reducing their cash positions and bank deposits significantly. They're moving money into alternative assets, private equity, hedge funds, real estate, commodities, art, anything but cash sitting in a bank. And they're doing something else: international diversification. Wealthy Americans are opening accounts in foreign banks, buying property overseas, establishing residency in other countries. They're creating options. They're building escape hatches. Why? Because they see instability ahead. They see the commercial real estate crisis. They see government debt at unsustainable levels. They see the dollar's position as global reserve currency potentially weakening. They see political instability and polarization. They see all the warning signs that historically precede major financial disruptions. And here's what's really concerning. Family offices, the private wealth management firms for the ultra-wealthy, are quietly advising their clients to diversify out of dollar-denominated assets and out of traditional banking relationships. These are institutions managing billions of dollars for wealthy families, and they're telling their clients to reduce exposure to the U.S. banking system. That should terrify you, because these people have access to the best financial minds in the world. They're not making panicked, emotional decisions. They're making calculated moves based on sophisticated analysis of risk. When billionaires start moving money out of the system, it's not because they're paranoid. It's because they know something. And what they know should concern all of us. Now let's talk about something that connects to all of this but isn't getting nearly enough attention. The push for a central bank digital currency, or CBDC, a digital dollar. The Federal Reserve has been actively researching and developing a digital version of the dollar. Other countries, including China, are already implementing their CBDC, and the implications of this are profound. A CBDC would essentially eliminate the need for traditional banking as we know it. Every American would have a direct account with the Federal Reserve. Every transaction would be recorded, monitored, and controlled by the central bank. There would be no cash, no privacy, no ability to transact outside the system. And here's the concerning part. A CBDC would give the government unprecedented control over your money. They could implement negative interest rates instantly. They could set expiration dates on money to force spending. They could restrict what you can purchase. They could freeze your account without needing to go through a bank. This sounds dystopian, but it's not speculation. These capabilities are built into CBDC systems, and various government officials and central bankers have explicitly discussed using these features for, quote, their words, not mine. Now, you might think this is far off in the future, but here's the thing. Financial crises accelerate change. When the current banking system faces severe stress, which many believe is coming, the solution that will be offered is a CBDC. They'll say it's safer, more stable, more efficient. And the silent bank run we're seeing right now, it's setting the stage for that transition. Because when banks are weakened by deposit flight, when confidence is shaken, when people are scared, that's when they'll accept solutions they would have rejected in normal times. Some people pulling money out of banks understand this. They're getting their money out of the digital banking system while they still can. Because once a CBDC is implemented, there may not be in quote 3 anymore. Your money will exist only as digits in a government database, subject to rules that can change at any time. If you think this is alarmist, let me tell you what's already happened in other countries, because the playbook exists, and we'd be foolish to think it can't happen here. Cyprus, 2013. The government, facing a banking crisis, implemented a bail-in. They took money directly from bank accounts over a certain threshold to rescue failing banks. People woke up one morning and found that 47.5% of their deposits over €100,000 were gone. Seized. Used to bail out banks. Greece, 2015. Capital controls were imposed. Banks closed. ATMs were limited to €60 per day withdrawals. People couldn't access their own money. This lasted for weeks. People who had their life savings in Greek banks were suddenly trapped, unable to pay bills or buy necessities. India, 2016. The government announced that 86% of currency in circulation would be demonetized overnight. Literally overnight. The 2 largest denomination bills were declared invalid. People had to deposit cash into banks and could only withdraw small amounts. The stated goal was fighting corruption, but the real effect was forcing people into the digital banking system and giving the government complete visibility into people's finances. Lebanon, 2019 to present. The banking system collapsed. People still can't access their full deposits. Banks impose arbitrary limits on withdrawals. The Lebanese pound has lost over 90% of its value. People who had their savings in Lebanese banks have effectively lost everything. These aren't theoretical scenarios. This is recent history. And in every case, the people who saw it coming and got their money out early were the ones who survived financially intact. The people who trusted the system, who believed their government wouldn't let banks fail or wouldn't confiscate deposits, those people lost everything. And here's the key point. In every single one of these cases, authorities said it couldn't happen, right up until it did. They said deposits were safe. They said the banking system was sound. They said there was no reason to worry. And then, suddenly, there was every reason to worry. But let's zoom out from banking specifically and look at the broader economic warning signs, because they all connect. Credit card debt in America just hit an all-time high of over $1.1 trillion. Student loan debt is over $1.7 trillion. Auto loan debt is at record levels. Mortgage debt, obviously massive. The total household debt in America is approaching $18 trillion. At the same time, savings rates have plummeted. The personal savings rate, the percentage of disposable income that people save, has dropped to around 4%, down from over 10% just a few years ago. People are saving less and borrowing more. This is the opposite of what you'd expect if people were pulling money out of banks to save it elsewhere. So where's the disconnect? Here's what's actually happening. The wealthy and financially informed are pulling money out and putting it into assets. The middle class and working class are being squeezed so hard by inflation and stagnant wages that they're drawing down what savings they had and going into debt just to maintain their standard of living. So bank deposits are falling not just because people are moving money strategically, but also because people are spending down their savings to survive. Both groups are pulling money out, but for very different reasons, and this creates a dangerous feedback loop. As deposits decline, banks have less money to lend. As lending decreases, economic activity slows. As the economy slows, more people struggle financially and need to access their savings, which causes more deposit withdrawals, which weakens banks further. We're in the early stages of this cycle right now. Most people don't see it yet because the stock market is still elevated, because unemployment numbers still look okay on the surface, because the full effects haven't hit yet. But the leading indicators, the things that predict what's coming next, are all flashing warning signs. Consumer confidence is dropping. Delinquencies on credit cards and auto loans are rising. Small businesses are struggling. Regional banks are under stress. And through it all, deposits keep flowing out of the banking system. Quietly, steadily, like water slowly draining from a bathtub. Look, I know this is heavy. I know it's scary. But here's the truth. The silent bank run happening right now is a signal. It's millions of people making millions of individual decisions, all pointing to the same conclusion: as something is very wrong with our banking system. Maybe it gets fixed. Maybe regulatory action stabilizes things. Maybe we muddle through, but maybe we don't. And the cost of being wrong, of trusting blindly when the warning signs are everywhere, is too high. The people pulling their money out aren't crazy. They're not paranoid. They're reading the data, understanding history, and taking rational precautions. You should be too. This isn't being reported on mainstream news. Banks don't want you to know about this because knowledge creates action. And action means more withdrawals. The government doesn't want panic. So they downplay it, ignore it, pretend it's not happening. But it is happening. The data doesn't lie. And you deserve to know the truth. If this video opened your eyes, share it. More people need to see this. Subscribe for more investigations into what's really happening in America's financial system. And whatever you decide to do with your money, do it thoughtfully, do it carefully, and do it soon. Because silent bank runs don't stay silent forever. Thanks for watching. Stay informed. Stay prepared. I'll see you in the next one.